Hi, this is Randy Finney with the right side of the chart, and this is a morning market update for Wednesday, February 6, 2019. We'll keep this one members only. Take a quick look at the broad markets, look at crude oil, the usual stuff that I cover. Now, again, the broad markets and crude oil, for the most part, have been trading with a highly positive correlation for weeks now, if not actually months. Although there's been a recent disconnect. I posted that in the trading room. I'll try to grab that chart here in a second. But let's start out with the good stuff. The good stuff being for those that are short or expecting a pullback, looking to get short. We finally have a breakdown here of this 60-minute wedge. Now, I do have to say this. Yes, the market's been extremely resilient. We've had divergences and breakdowns that have played out. The divergences, I say more often than not, do play out. Um, I'd say well over 90% of the time when you have divergent highs, especially when you get sell signals like trendline breaks. However, they just haven't been playing out for what you normally might expect. For example, we have this large wedge pattern here. You had this divergent high, this large wedge. And when you take the measured pattern of a wedge, you take the widest part of the wedge and you add that to where prices break down. And so therefore that should have brought us down to my target at the time, and it didn't. But it did have a correction. So, don't get me wrong. I was wrong on this call because we didn't hit that first target. That last trade was stopped out. I'm just pointing out a fact that the market has been resilient. Not trading that well to the technicals has been a very strong trend. Um, Nothing lasts forever. What I would point you to is look back in the highs leading up to October or so, how resilient the market was then until it broke down. We had a lot of shorter term breakdowns before that top was finally put in. And if you recall, it looked like there was no end to the bottom. Bullish chart patterns weren't playing out, or they would play out little bullish divergences and breakouts only for small pops until they finally started to play out. So the point I'm trying to make is nothing lasts forever. And so we've had a very strong uptrend. We're very overbought now, or quite overbought, I should say. And more importantly, these are chart patterns, buy and sell triggers, things that I've been using for decades now, really. And if to stop all of a sudden because these pullbacks haven't hit the measured target, to stop using those would be ridiculous. I might as well hang things up and pick a new career. So I just wanted to say that sometimes the charts work much better than others. If I, I'm sure there's some things I missed in the charts, and there's certainly some things I've dismissed recently, like the strong breath and all that. But again, to do it all over again, not knowing the results, I would do the same thing. This is what I do. So, 9 times out of 10, you short rising wedge patterns like this or this, they play out to the measured target, or maybe not 9 times out of 10, but a much higher success ratio than we've had lately. All right, so with that being said, again, good news. This is clean. This is as good as it gets. We've had that period where the bigger wedge broke down, and we had, instead of a correction in price, it was more of a correction in time, which I talked about. That was it. That's what we had to work off or to really satisfy these divergences down here in the rising wedge and everything else. And then within there, you have these smaller patterns. And as I often say, we're here on a 60-minute chart of the NQ NASDAQ 100 futures. And, you get the bigger divergences usually lead to bigger corrections. This one wasn't very big in price, but it was in time. And then you have these smaller divergences. These are small bullish divergent lows. Each of those led to little pops there. And not much. This one was a little bit bigger, but you can see here we've been diverging for a while. We had a small divergent high there, and it played out for a little correction. Then we had a little bit larger divergent high right there. Didn't play out, but what happened is we went on here. The RSI popped up a little bit. It's about flat. It's really flat line divergence. I should have a line like this from this peak to that peak. So that is negative divergence right here to here, and we kept the divergence clean with the lower low on the PPO. So that's it. Spent a lot of time talking about this chart. It's not a very big pattern, but there's a lot of hot air in this market. And let's see if this will be the trigger, the catalyst we finally need to get a decent pullback. So we'll leave the targets on. In fact, let's look at that real quick since that's NQ. Might as well go to QQQ. Let me find that chart. Okay, here's our official trade, the most recent one. There's our stop right there. So we're still okay. We're still under the stop. And this is comparable to that trend line I was just showing you on the NASDAQ 100 futures, the E-minis. And so you can see I draw that trend line and we can either tighten it up. This is probably the best draw. And if you want, you can include that little reaction there. But coming in like this, I think we capture a few more candles. But it's moot because the line comes in here the same way. So this is a sell signal. Will this one play out this time for a pretty decent correction? I can't promise you that, but I can tell you it's about as objective a sell signal as we've had now in a while. And so that's I think we'll see more downside today and into tomorrow, possibly even into next week. And these remain the targets for now and the official stop. Another draw on QQQ that I can do is a trend line off the lows on the 24th. Come in here, almost capture that reaction low there, capture a couple of lows. When you draw it on QQQ, you have a little breakdown here. Otherwise, I'd have to do this, and that's not a very solid trend line because we only have 2 points two reactions off it. And like I always say, it takes at least three to have a valid trend line. So this is the fit that I think works better. And if you look at SPY, it also, you can see on SPY, we have even a better fit there. So this one has yet to crack, and this is again the trend line. I would say it is more significant. It doesn't have as many reactions as the one I just showed you on QQQ and the NASDAQ 100 futures. That one was really off here, off this recent lows right here to here. But it is one to watch. There are probably a lot of traders watching this one as well. Again, not a lot of reactions, but that's what it looks like on SPY. And you can see some pretty big divergences. So yeah, I have very little doubt that a decent tradable correction is coming. We just need to get the right catalyst. And the one thing about this market is it's a one-sided market. Other than the recent consolidation we had, this market has two speeds. Full forward and full reverse, like we've seen in the last few months. It seems to be there's a lot of traders just jump on one side of the trade or whatever it is, one side or the other, whether it's a bullish or bearish trend. And so don't underestimate just how far or fast things can fall once this train changes tracks. It hasn't done so yet, but let's just keep an eye on it. And on a related note, this is TVIX, the official trade we have on the volatility, 2 times inverse short-term ETN. And again, this one, a lot like trading crude recently, it's either going to play out or not play out depending on what the broad market does because of the correlation. TVIX will almost trade directly inversely to the stock market. So we need to get a little now. Surprising, we're down today slightly on the indexes, and TVIX is also down. That's unusual, but that doesn't concern me because every now and then you'll have temporary disconnects between certain asset classes or certain securities. So again, bigger picture, I still like it. And if you recall, let's see if I still have my annotations on the VIX. Cleaned some charts up recently. There it is. Yeah, this is a major support zone right here. And this was, again, the basis for that trade. Lots of reactions on this level, on this support zone. Resistance, resistance, resistance on these three attempts. It capped those. Support there. Brief undershoot. Remember, the VIX is very volatile, so you're going to have over and undershoots of support and resistance levels. That's to be expected. But you can see, Mike, these are the key levels. And again, this is a support zone. It was resistance there, resistance, support, support, and we're at the bottom of it now. So, it's nothing to say that we can't break it just because it's a support zone. You don't have to have a reaction, but I would be surprised, really surprised if we fell from here all the way down to my next support zone without at least a bounce here soon off the bottom of that zone. And so, this would, the bearish scenario with another leg down in the markets would look something like this. Now, if the stock market's going to new highs in the coming weeks to months, then you would expect us to work our way back down, at least to this next support zone. But again, that's not my preferred scenario at this point in time. Okay, I started out with the NQ NASDAQ 100 futures. I then rolled into QQQ, and I covered SPY, but I didn't cover ES for you futures traders. Plus, I like to incorporate futures into my analysis, even if I were to be only trading the ETFs. I still think it's worth keeping an eye on the futures. So ES, similar story to NQ. You have a nice, clean, rising wedge pattern, as I've just drawn out here. We've just cracked down below it today. We're probably back testing right now as I speak. I'd have to zoom in a little bit there, but I can see a little kickback in the markets on another monitor as I'm doing the video. But we've just been diverging and diverging and diverging. And from my experience, the longer you continue to move higher with these divergences still intact, unless they get taken out, by taken out, I mean we move up back above the previous highs, then we no longer have negative divergence. But as long as we continue to diverge, it just sets the stage, I believe, for a more significant pullback. And on ES, I can tell you right now, a preferred swing target, and wouldn't be necessarily my final target, but if I were to be trading ES, which I'm not, I'm an NQ, but this is where I'd focus on 26.26, and to try to measure it out, and this will give us an idea if that does happen. You're looking at a drop of about what is that? About three. It's hard to see that there. It's about 3.8% or so, almost a 4% drop, and that would be well, I can't say my minimum target because there's pretty decent support here. So I think it would look something like this. We have support, a support zone there. I think a correction over the next coming few days would be something along these lines like this, with a reaction there. And then we'll just have to assess the charts if and when we get there to see if it looks like we're going to get more downside or not. Okay, and I mentioned the correlation, which had been a very, very tight inverse correlation between, or I'm sorry, direct correlation, not inverse, a direct one-to-one correlation between the crude oil and the stock market. Here's USO in white overlaid with SPY in green. I posted this in the trading room yesterday. And when you do chart comparisons, don't look at the differential between the two. You see these gaps. Look at what direction are they both moving up at the same time. Sometimes you'll have one that might rise. For example, crude will tend to go up more in percentage terms than the stock market. On a good day, crude can rally, 3, 4, 5%. Stock market, 1, 2. So that's why you see the bigger spikes. But again, it's the direction. It's almost identical now. But there has been a disconnect since this point. From here, you can see that right here we saw a stark reversal, and USO has been falling for the last few days while the stock market has continued to climb. So, what does it mean? We can't take too much. Sometimes you have a temporary disconnect and you get a mean reversion. But I think that, when they both are trading in tandem, one will always top, or usually will top before the other. And so I think what we're seeing here is crude oil peaking first with the stock market to come in soon. And let's take a look at the charts. Let's go to a 60-minute chart of USO. This is just a nice clean wedge. And again, it looks a lot like those wedges I showed you on the stock market, because this comes off the December 24th lows. That's the same day the market. Well, actually, you know what? The market's bottom. The 24th was the last down day, and then the 26th they started rising the day after Christmas, and there it is. So that's a clean wedge. A lot of reactions along there, and a very clean breakdown. Negative divergence, everything I like to see. I should have mentioned a minute ago. I'll jump back to it. I'm looking for a little more evidence here. This trend has been resilient, and one thing that's kept it there, and shame on me. I got ahead on these trades. I wanted to get ahead. I thought we'd see a deeper pullback in the last couple of weeks. I point out these trend indicators all the time. So in other words, these trend indicators hadn't fired or confirmed with sell signals yet. And I'm talking about the PPO 9EMA, the signal line. When it's above the zero line, that's the dotted white line, the trend is bullish. So from this point up until still today, it said the trend is bullish in crude. It hasn't crossed over yet. The PPO line has, but I use the signal line because that's the last of the two to cross. So by doing that, you filter out, it does a better job of filtering out whipsaw signals that you'll get with just using the PPO line. So I wanted to mention that it does look like we'll get across. I talk about this quite often. The zero line not only is a threshold to define bull and bear trends when it's above or below it, but it also acts as support or resistance when tested from above. Once you have a bullish trend, it tends to act as support as it did here, as it did here. But just like price support on a stock, tap, tap, tap. The more you tap on a support level, sooner or later it's going to give way. So with the posture right now of the MACD, and more important, if anything else, the fact that we had the negative divergence up into the high recently and now a breakdown. So there's, these are little check marks for the bearish case. Check, check, and we haven't had that yet. This is still pending, but it looks like we'll get it soon. So I may add that one back, but I've been reluctant. I've talked about adding DWT or USO back as an official trade. I just have to have the confidence. We're getting burned, or at least, I am in the official trades. Too many shorts. I'm not used to seeing this many trades just get stopped out. We're keeping the losses small. That's one thing. I'm not, we're talking 2-3% losses on most of the trades that have been stopped out recently. And so you only have to catch, one that gets, 8, 10, 12%, makes up for quite a few of those small losers. So that's the key, is keep the losses tight, and we'll catch one of the runner trades here soon, hopefully. And just real quick to jump back to QQQ, see there's the 60-minute trend indicators, clearly bullish on the Qs, clearly bullish on SPY. I have a different board there. And then jump back to the futures, we're getting close. I'll go back to ES, and you can see ES is dancing the line right now. We had successful back test of the zero line there, and we're on it now. Again, these divergences tell me we'll probably move on down through there soon. And it's not perfect. There's been some whipsaws, but I also often talk about that. Trend indicators just don't work in a sideways trading range. They tend to work good in trending markets. When you have a clear trend, crossover, there's your bullish cross. I had a little bit, well, it was not even a whipsaw signal. There was a big correction. That was a 3+% pullback there. But for the most part, it's traded above the zero line sense. So we're watching that one as well. And same story on NQ. There it is. There's NQ. So you can see last successful test there, the zero line. So those are the things I'm watching. All right, I think this is it. Let me just look at a couple things before I wrap this video up. Okay, just wanted to jump over to a 15-minute chart because I told you since I've started the video, we've had a little kickback rally. So what I did is this is a 15-minute chart of QQQ. So this is that very near-term trend line I showed you on both the futures and on QQQ and SPY earlier. There's a little wedge here on the 15-minute frame. Nice and clean. I mean, this is what I like to see, but it's been a resilient market. We broke down. The breakdown was impulsive. We have a kickback rally so far, and that's fine as long as we don't get back above there, that trend line or that far. Sometimes you will pop into a wedge and then reverse. Again, this market has been extremely resilient, and if nothing else, I'm going to leave it at this. This is not a time to be all in, aggressively with leverage. We have, some sell signals, but again, they haven't been playing out well. There's been just a voracious bid. Dips have been being bought back. A lot of red flags now. Volume has been tapering off sharply in the last couple days, so I do think we're going to get a pretty decent pullback soon. But I see, a lot of people trading the 3-time leverage ETFs, and that's fine too, because sometimes people buy those in an IRA or a non-margin account, a cash account, to gain short exposure where you normally can't short stocks. But if you're going to take SQQQ or any of the 3-time leverage ETFs, just factor that into your position size. You should take a third less than you would normally on QQQ. And even with QQQ right now, you may not want to go into a very heavy position. You can, if you're short or plan to short, you can always add to that position if the charts could start to develop a little more bearish. We start to break some other support levels. If you're looking for, again, you have to. It gets complicated. You have to define your trading. Your time frame on the trade, your price targets, and everything else. This is a 60-minute trade. This is a swing trade, and I imagine there's people right now if you're of the mindset that I am, that we may be in the early stages of a new bear market, and if so, then the next move down will undercut the lows. So you're talking about 16% drop right now just to get back to those December 24th lows. And again, if we're headed down to undercut those lows, the next wave down would probably undercut them by a pretty wide margin. So in other words, I would expect from where we're at today, and again, it's a big if. I've gone over this in a lot of videos recently. There's some long-term trend indicators, long-term support levels on some indexes and some of the key market-leading stocks that have yet to break. So we can't say with the absolute highest degree of confidence that we're in the early stages of a new bear market. There's a lot. I still think there's enough evidence to say that's quite likely, but not extremely likely, if that makes sense. Everything, there's no certainties in trading, and so I try to quantify things as best I can. So, point being, if we are going down, then again, the next leg down from where we're at today probably has at least another 20% downside. And if that means if we pop another three, then 23% downside. But if we don't, and you don't get married to it, because if this market gets a lot higher, if it gets close to those old highs, it's probably going to want to run through them. That's what the market usually does. When it comes back up and it tests a previous high, like right here, it usually pops above it. So you came up here, you had a reaction high, you came up, tested, pulled back a little, popped above it, then fell down. And you come up, you make a marginal new high, then you correct. Make a marginal new high, then you correct. So I just want to make mention that I really don't want to see the market. I don't believe it'll get much above this level here, but anything is possible, and that's what stops are for. Because if you are short from here all the way to here, you're going to feel a lot of pain. That's going to be devastating to your portfolio, and you may never recover from it, at least on that trade. Okay, we're going to wrap up. But since I'm doing this for members, I'll talk about TLT as well. I mentioned that yesterday. Yes, that was a front page post. So Silver members should have also received a notification on that. Looks pretty good as long as it holds above this trend line. There are no guarantees, but it's a pullback to support. It's a pretty well-defined trend line support. We're up again. So if you zoom in a little tighter, you can see we hit that trend line there, cut it intraday, but again, doesn't matter what happens intraday. We had a nice close on it with that doji candlestick, and so far 2 days of green candles. So that is a successful defense of the uptrend line. And if somebody asked, would I add it as an official trade? I did. No. A couple reasons. Number one, I don't see enough meat on the bone. Now we have a pretty significant resistance here at about 122.50, and then the previous reaction high above. Um, and again, it's just my degree of confidence isn't that high. But I did say this personally. I still think, I mentioned the last couple of weeks adding money back into treasuries on my long-term funds, 401k type money, moving that into treasury funds, because I also see very little downside. And, if it drops down here to that 119.33-ish support again, from here, it's about a 1.7% drop. And the nice thing about TLT is it kicks out monthly interest or dividends off the bonds that it holds. So even if it's a dead money trade for the next 6 months, meaning trade sideways in a range, I will be, assuming it doesn't go, much lower, then I'll be profitable in the trade. I'll have something. I'll have the income or the dividends that are kicking off that trade. Again, if I'm in it 6 months from now, which I may or may not be. All right, we'll wrap up here, and then I will focus. I'll take another look. I need to do an update on some of the trade ideas. RKDA started to move yesterday impulsively. I might have to, I think there's one more to be stopped out, a couple that hit a stop, one or two. I'll do that in a separate video, guys. So I'm sorry. Some of those trades may still be listed as active. Some still look good, but always if a trade hits a final price target or a maximum suggested stop, I will take it off because I'm consistent with that. I might share my thoughts. I might tell you I'm still in the trade. I might tell you I still like it. But unless I change the trade parameters before they're hit, the final target or the stop, that trade is officially considered stopped out. And as soon as I get a chance, I go to the trade, update it, post a front page update, and then move it to the completed trades. And as always, if you have questions on those or any other trade ideas, just drop me a line in the trading room, and I'll be more than glad to share my thoughts. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.